Center for the Ethiopian Educational Information and Communication Technology presents Educational Satellite Television Programs.
Hello, teacher. Hello, students. Welcome to today's lesson about taxation. In the last lesson, we learned about investing and borrowing money. Today, we will learn about the different types and principles of taxation. Are you ready, students? Let us begin by defining taxation. A tax is a financial charge or levy upon a taxpayer by a state. Failure to pay tax is punishable by law. Taxes are divided into three parts. Allocation describes the provision of various governmental services and the apportioning of resources to these various ends. The services range from national defense to education. Distribution is defined as the activities involving the redistribution of income. This includes welfare programs and scaling tax structures. Stabilization and growth describes the activities designed to increase economic stability. Among these are promoting economic growth and lessening unemployment. A government imposes taxes to raise revenue. This covers the cost of administration, police and law, defense, education, housing, health, pensions, and family allowances, among many others. The 18th century economist and social philosopher Adam Smith described the principles of taxation in his book, The Wealth of Nations. These ideas form the foundation of all modern taxation. The subjects of every state ought to contribute towards the support of the government as nearly as possible, in proportion to their respective abilities, that is, in proportion to the revenue which they can respectively enjoy under the protection of the state. Students, it is time for an activity. These are statements regarding taxation and services. Can you fill in the blank areas in each sentence? Take a few minutes to do this now.
Students, let's get ready. Begin. Time's up! Let's get back to our lesson.
Welcome back, students. Let us review the correct answers together. A tax is a financial charge or levy upon a taxpayer by a state. Allocation describes the provision of services. The services range from national defense to education. Distribution is the redistribution of income. This includes welfare programs and scaling tax structures. Stabilization and growth increases economic stability. This includes economic growth and lessening unemployment. Were you able to fill in all the blanks, students? If so, great job. In Ethiopia, taxes are classified on the basis of impact and incidence. This means that they are determined by the ability to the taxpayer to pay and the type of taxation. They are classified into two broad categories: direct and indirect taxes. Let us first study direct tax. A direct tax is paid directly by the taxpayer with no intermediaries. The tax cannot be transferred through a third party. Direct taxes, according to Ethiopian tax law, include all income taxes: employment income tax, business income tax, land use fees, mining income tax, and all other income-based taxes. The government of Ethiopia has divided up the direct taxes into 4 tax bases. Schedule A taxes pertain to income from employment. Schedule B taxes pertain to building rental. Schedule C taxes pertain to income from business. Schedule D taxes include the remaining categories, such as royalties, gambling winnings, dividend and interest income, and gains from the transfer of investment property. An indirect tax can be shifted from one taxpayer onto others. Generally speaking, the incidence of indirect tax is on the consumer. However, sometimes a seller might absorb indirect tax to be competitive in the market. This action reduces direct profit, so the seller hopes to sell more units to compensate for the loss. Indirect taxes are based on consumption. In Ethiopia, this tax category includes the following: value-added tax, a levy that is imposed on business at all levels of production and distribution of goods and services. Turnover tax applies to all those who supply goods and services in Ethiopia but are not required to pay the VAT. It is intended as a balancing mechanism. Excise tax is levied on specific goods supplied in Ethiopia. The major items are sugar, salt, tobacco, alcohol, textiles, fuel, jewels, vehicles, and televisions. Customs duty is the tariff that is imposed directly on the import and export of goods and services. It is levied on the cost of production for locally produced exports and the cost, insurance, and freight of import items. It is time for another activity, students. We have learned about the different types of taxes and tariffs in Ethiopia. Let us see examples of how they are applied. These are different situations in which someone must pay a tax. In each instance, can you determine which tax is applicable? Working with a partner, see if you can answer this question.
Students, let's get ready. Begin. Time's up. Let's get back to our lesson.
Hello, students. There is much tax to be paid. Were you able to determine who must pay what tax? Let us look at your answers. Samsung Electronics must pay value-added tax on its purchases. Alamy 2 must pay Schedule A taxes on his employment income. Fitsum must pay Schedule B taxes on the income from renting his house. Kalili must pay Schedule D taxes on his gambling winnings. He is still a lucky fellow, though. It is possible that the bakery would have to pay value-added taxes. However, it seems like a small business and will more likely have to pay turnover tax. Onash Exports must pay customs duties on its coffee, including the cost of insurance and freight. Were those your answers, students? Great work. That is all for today's lesson, students. We have learned about the different types of taxation. Until next lesson, thank you, teacher. Thank you, students.